they have incurred the flotation cost of how many rupees? 3%. So 3% of 1000, it will be 30 rupees. So 970 will be your net receipts. What is the formula for calculating the cost of equity? Cost of equity is equal to dividend divided by net proceeds or market price plus growth. What is the net proceeds? Market value is not given, market price is not given. So 20 per share will be the net receipts. Hello everybody, I'm Divya, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. I welcome you all for session 9 on your chapter 1, that is cost of capital. So in the last class, my dear students, we have discussed regarding the specific cost. We have calculated cost of equity, cost of debenture and cost of preference share. In today's class, we will learn your 15 marks problem, that is your WAC problem, weighted average cost of capital. Moving forward, so let us understand the problem first. As I have told you, my dear students, it is very important for you all to read out the questions carefully. So if you don't read out the question carefully, you don't understand the given in the question. So let's understand the question in a better way. So problem number 1 on your 15 marks problem, that is your WAC problem. So this class is very important for you all because these are the 15 marks. So if you learn this, 15 marks will be in your pocket in your examination. So the following is the capital structure of C Limited equity shares. 20,000 shares of rupees 100 each of rupees 20 lakh. So what is equity share value? 20 lakh is this equity share value. What is the face value given? 100 rupees each. So 10% preference shares of rupees 100 each of rupees 8 lakh. 12% debenture of rupees 12 lakh. So the market price of the company share is rupees 110 and it is expected that the dividend is rupees 10 per share would be declared. So the dividend growth rate is 6%. In this problem, what are the sources of finance they have utilized? Equity shares, debentures and preference shares. So there is no equity, there is no retained earnings used. So the source of finance will be equity share, debentures and your preference shares. So in this, reading the question itself, you will be able to understand whether it is a redeemable problem or a irredeemable problem. Redeemable preference share is given or irredeemable preference share is given. Irredeemable debenture or redeemable debenture is given. So read out the questions carefully. So in this problem, it is irredeemable problem because the number of years and the maturity value is not given. So if the company's tax rate is 50%, compute the WAC. So first thing what you have to do in this case, you have to calculate the specific cost using the formula and then calculate the WAC. So what is the WAC format? So in the initial days of the class itself, we have discussed what is WAC format. So kindly go back to the previous classes and note down the WAC format. So next is B case, assuming that in order to finance an expansion plan, the company want to expand its business. So they have borrowed a fund of rupees 20 lakh bearing how many percent interest? 14% is the interest rate. So they have taken up the another source of finance for expanding their business, that is your debt capital of rupees 20 lakh, 14% interest. So for this you have to calculate the separate cost, specific cost, and then calculate the new WAC. And this financing decision is expected to increase dividend from rupees 12.10 to rupees 12 per share. So earlier what was the dividend rate? 10 rupees is the dividend rate, and what is now they have thought? They have thought of increasing the dividend, that is your 12 rupees. So and the market price is 105. So let us solve the problem. So what is given first? Given is equity share. So let's calculate the cost of equity shares. So what is the value they have given? Equity shares 20,000 share of rupees 100 each. 20 lakh, and further they have given more information about equity share. What is that? The market price of the company share is 110 rupees, and the company is expected to pay the dividend of rupees 10, and what is the growth rate they have given? 6% is the growth rate they have given. So what is the formula for calculating the cost of equity? Cost of equity is equal to dividend divided by net proceeds or market price plus growth. Since the market price is given, my dear students, you people have to take up market price value for the consideration whenever market price is given. Let's calculate. Moving further, given. So what is given? Dividend is given of 10 rupees and your growth rate is 6%, that is 0.06, and your market price is 110. So when you substitute all the values to the formula, the value you get, the cost of equity you get is 15.909%. So what the value you get? 15.09%. And the next is, they have given information regarding 10% preference shares of rupees 100 each of rupees 8 lakh. So it is an irredeemable problem. So what is the formula? Cost of preference is equal to your dividend divided by net proceeds. So what is the dividend? 10% is the dividend on how many rupees? 100 rupees. So your dividend will be 10 rupees and your net proceeds will be 100. So if you substitute the values, you'll get as 10%. Next, what is the further information is given? 12% debenture of rupees 12 lakh. So 12 lakh, 12% debenture, and what is the further information they have given? Tax rate is given, 50% is the tax rate. So it is what? It is irredeemable problem after tax. So what is the formula? Formula will be 1 minus tax interest plus your dividend divided by, so what is the formula? The formula will be 1 minus tax interest divided by net proceeds. So what is given in the question? Net proceeds is given, that is your 12 lakh is the net proceeds. What is the interest rate? 12% in the interest rate. And what is the tax rate that is given? 50%. So if you substitute the value, you will get, so what's the formula? Cost of debenture is equal to interest 1 minus tax divided by net proceeds. So 12 lakh into 12%, it will be how much? 1,44,000 will be the interest rate. If you convert that tax percent, 50%, so 50 divided by 100, if you calculate, the value you get is 0.50. So 1 minus tax 0.50, that will be 0.5. So interest tax divided by your 12 lakhs. So that is your net proceeds. So if you do the substitute the values, you'll get the answer as 6%. Moving forward, now this is the computation of WACC. WACC stands for weighted average cost of capital. So it is also denoted as KOK, subscript with O. So what is this? It includes all the costs. So how do you get it? So specific cost. What are the sources of finance we have used? Equity shares, debentures and preference share. All the specific cost we have calculated. So if we add the overall capital, that is your equity, preference and your debenture, we will get what? Your overall cost of capital. So this is the format of calculating your WACC. So what is the first column? Sources of finance. Equity share, we have used 12% debenture, 10% is the preference share. So what is this book value given in the question? So that is your 20 lakh of equity shares, 12 lakh of your debenture and 8 lakh of your preference shares that is given in the question. So you have written that book value and the total of that. And next column is about weight. So how do you get this weight? So 40 lakh, that is your total weight. So individual value divided by total value, you get your weight. So individual book value is 20 lakh divided by 40 lakh. The weight you got is 0.5. So similarly, we have 40 lakh here, 12 lakh as an individual book value. So what is this book value? 12 lakh. 12 lakh divided by 40 lakh. The answer you get is 0.3. That is the weight of a debenture. So what is your preference share? Book value is 8 lakh divided by 40 lakh. The weight you get is 0.2. And this specific cost we have calculated. So what is the specific cost of equity capital? 15%. Specific cost of debenture 6%, and your preference is 10%. So we have directly taken all the specific cost. So and next column that we have to compute is weighted average cost. So how do you get that weighted average cost? If you multiply weight with specific cost, 0.5 into 15.09, you'll get the value as 7.545. So what is that value? So it is nothing but weighted average cost of equity capital. And next is weight into specific cost, that is your 0.3 into 6, 1.8 will be the percentage. This is 1.8 percentage, 7.545 percentage, and what is the specific weight of your preference share? That is your 0.2 into 10. The value you get is 2%. So the overall cost, if you add the column, if you summarize the given information, the value you get is 11.345%. So this is the overall weight. So this is for the case 1, that is your condition 1. What the information further they have given? They have given the information regarding expanding the business. So they have used the additional capital, that is debenture of 20 lakh, 14% interest in order to enhance the profit and the growth. So what is the dividend they have declared? From 10 rupees to, they have thought of increasing the dividend rupees 12, and the market price was rupees 110 and it has decreased by 105. So we have to compute the specific cost for 20 lakh debenture as well as cost of equity, because we are enhancing, we are increasing the number of dividend, we are increasing the amount of dividend. So let us calculate that. Cost of debt, again rest of the information remains similar. Interest divided by net proceeds 1 minus tax. Your interest will be 20 lakh into 14%. So 14% is the interest rate on rupees 20 lakh. So the value you get is 2,80,000. Net proceeds will be 20 lakh, since we are using additional capital to our company in order to expand the business. So 1 minus 0.50, if you substitute the value, the answer you get is 7%. And next is, we are calculating equity capital. Why we are calculating equity capital? Because from 10 rupees dividend to the declaration of dividend is now 12 rupees, and the market price from 110 to, it has been decreased to 105. So for that purpose, we have to calculate the cost of equity and find out what is the overall cost, because we are increased the debenture. So dividend divided by net proceeds or market price plus growth. Growth rate remains similar, 0.066%. 12 rupees is the dividend. The market price is 105. So if you substitute the value, you get is 7.43. So how did you get that 7.43? 12 plus 0.06 divided by 105. If you do, you will get the value as 0.1743, and if you wanted to convert them into percentage, if you multiply with 100, you will get 17.43%. So this is all in percentage. So now let us calculate the new WACC. So computation of new weighted average cost of capital because of the increasing in the debenture. So what is the debenture that we have increased? 14% debenture of 20 lakhs. So rest remains same. 12% debenture, that is your 12 lakh rupees. The weight and the specific cost we have calculated, that remains same. 10% preference share, 8 lakh, and the specific cost we have calculated remains same. See here, 10%, and only the equity capital as well as this debenture will change. Equity capital book value remains same because only we are changing in the dividend and the market price, not the book value of the equity share. So book value, equity, capital remains the same. What we have calculated now, that equity percentage we are taking it here, and the additional debenture that we have taken 20 lakh, we are adding to that. So your new book value will be 16 lakh. So 60 lakh is the total book value. So compute the weight, 12 lakh divided by 60 lakh, 0.1. 8 lakh divided by 60 lakh, the value will be 0.13. 20 lakh divided by 60 lakh, the value will be 0.33. Again 20 lakh divided by 60 lakh, the weight will be 0.23. If you multiply weight into specific cost, you will get weighted average cost of each source of finance. If you add it, you will get it overall cost of capital. So what was the previous overall cost of capital? It was 11.345%. Since we have increased the debenture, the overall cost will be 10.56%. Moving forward, to make you more understanding in a better way, we'll take up one more problem and solve the problem. So understand the questions carefully. The following is the capital structure of company. Determine weighted average cost of capital. Equity share capital 20 lakh, preference shares 8 lakh and debenture is 12 lakh. External financing information is equity share selling price 120 per share. The expected growth rate is 7%. The expected dividend at the current year, that is your 11 rupees. What is this? Dividend. And expenses for issuing the share is rupees 8. So what is given with respect to equity share? Again, the sources of finance that is used in this company is equity, preference and debenture. There is no retained earnings used. So equity share, the given information is what? Growth rate is given, your net proceeds is given and your dividend is given, but the expenses have been incurred while issuing the shares, that is 8 rupees is given. So let's substitute all the values to the formula and check out the formula. So cost of equity is equal to dividend divided by net proceeds plus growth. So here 11 per share, growth is 7%. So net proceeds is how much? 120 rupees is the net proceeds. We are deducting 8 rupees. What? 8 rupees is the expenses. The value you get is 112 as net proceeds. So net proceeds we have taken, the expenses we have taken. So 112 will be your net proceeds. 11 rupees is your dividend. Growth rate is 7% that you are converted into decimal. 7 divided by 100, it will be 0.07. If you substitute the value 11 divided by 112 plus 0.07, you get 0.168 into 100. If you want to convert that into percentage, the value you get is 16.8%. And the next thing is 15 years, 14% debenture of rupees 1000 each, face value, redeemable at 5% premium, sold at par, but 3% is your flotation cost. So my dear students, it is redeemable problem. So redeemable problem, tax rate is given, redeemable after tax problem. So 15 years, number of years is given how much? 15 years, interest rate is 14%. 14% into 1000 rupees, how much it will be? 1000 rupees. 14% on 1000 rupees, it will be 140. So your interest rate will be 140. And next, what is given? While redeeming, they are redeeming at 5% premium. So redeeming value will be 5% premium. So your maturity price will be how much? Maturity price. So 1000 into 5%, it will be 50 rupees. So 1050 rupees will be your maturity price. So after redeeming, because we are redeeming at a premium but sold at a par. but they have incurred the flotation cost of how many rupees? 3%. So 3% of 1000, it will be 30 rupees. So 970 will be your net proceeds. So net proceeds is 970, interest is 140, maturity value is 1050. Your tax rate is how much? 35%. Tax rate is 35%. 1 minus 0.35, you will get the value as 0.65. So interest 140. The formula for calculating your redeemable preference share after tax will be cost of debt is equal to interest 1 minus tax plus maturity price minus net proceeds divided by number of years whole divided by maturity price plus net proceeds divided by 2. So 140 is your interest rate, 0.65 is your tax rate, this was your maturity price, net proceeds divided by number of years whole divided by, that is your maturity price plus net proceeds divided by 2. So first solve this bracket first, and what the value you get, keep it the same. Second, you solve this bracket first, keep the value same, and then multiply this value 0.65 value with 140, then add this value with the bracket part and then divide it with the denominator value. You get the answer it as 9.5%. So 5.3 you get, 1110 you get if you solve this bracket. So multiplying this with the interest, adding that amount with the 5.3 value, you get 96.3 divided by the denominator fraction value, that is your 1010, the value you get is 0.095. If you convert that into the percentage, you get is 9.5%. So moving forward, we have preferential shares. Even the preferential shares is redeemable preferential share because number of years is given and the redeeming value is given. So 7 years, 12% preference share. So what is this 12%? Dividend is the 12%. Number of years is 7. 100 rupees is what? Your face value, sold at a par but redeemed at a 5% premium. So what is this? While redeeming, they are redeeming at 5% premium. Again, for this also 3% flotation cost. Moving forward, let us calculate cost of preference. So what is the formula? Preferential dividend plus maturity price minus your net proceeds divided by number of years and again divided by maturity price plus net proceeds divided by 2. So let's substitute all the values and check out the answer. So what is the preferential dividend? Preferential dividend is 12 rupees. And what is the maturity price? Maturity price, since we are redeeming at 5% premium, so it is 105 rupees. So 105 is your maturity price and net proceeds. So while issuing, we are issued at par. So in that 2% flotation cost has been incurred. So 100 minus 2%, it is 2 rupees. So 100 minus 2, it is 98. So let's substitute that. So to the formula. So 98 is the net proceeds divided by number of years. So what is number of years? 7 years. Again divided by 105 plus 98 divided by 2. So if you put that value to the calculator, you get 13 divided by 101.5, and when you convert that into the percentage, you will get what? 12.8%. So what is the preferential dividend when it is redeemed at a premium of 5%? The preferential dividend, that is your cost of preference shares, will be how much? It is 12%. Moving forward, so now let us compute the WACC. So WACC format, specific cost, book value, weight, specific cost, the computation of WACC. So let us solve the WACC. So what is this? Sources of finance, book value, weight, specific cost and weighted average cost. So sources of finance, equity capital, 14% debenture, 12% preference shares. So the book value is how much? The book value is 20 lakh, 12 lakh and 8 lakh. So we have taken 20 lakh, 12 lakh and 8 lakh. The total of it is 40 lakh. So how do you get this weight? 20 lakh divided by 40 lakh, 0.5. 12 lakh divided by 40 lakh, it is 0.3. 8 lakh divided by 40 lakh, the answer you get is 0.2. So next is specific cost. So what is the specific cost of equity? 16.8%. We have written 16.8%. And next, what is the specific cost of debt? It is 9.5%. We have written. And specific cost of preference 12.8%. So multiply weight into specific cost. The answer what we get will be weighted average cost. So 8.43, 0.3 into 9.53, 2.86, 0.2 into 12.8, 2.56. The total of it will be overall cost of capital, that is your WACC. It is how much? 13.82%. Moving forward, let us take one more problem for your easy understanding. Z company has the following capital structure: equity shares 20,000 shares of rupees 20 each. So 20,000 shares, 20 rupees each. 20 rupees is the face value. 4 lakh 6% preference shares of rupees 10 lakh, 8 lakh preference shares of rupees 100 each, 30 lakh. The equity share of the company is sold at 20 per share. So what is this? It is your net proceeds. If there is expected that the company is paid dividend 2 rupees per share, and what is the growth rate? 0.07. 7% is the growth rate, and the tax rate is 50%. So say 50% if you convert into the decimal, 0.50. So you require to compute the existing capital structure, WACC, and also the new WACC, because they have raised 10% debenture of rupees 20 lakhs. Since they have raised the fund, they raised the debenture, they are thinking of issuing the debenture of rupees how much? 3 per share. So the growth rates remains changed, but the price of the share will be 15 rupees. So it has been decreased 15 per share. So now let's calculate the specific cost first and then compute the existing. For the existing capital structure, calculate the WACC and then calculate the new specific cost and then new weighted average cost of capital. So with the further information given, cost of equity, what all information is given? Rupees 20 per share. So what is the net proceeds? Market value is not given, market price is not given. So 20 per share will be the net proceeds. The growth rate is given, 0.07 is the growth rate, and the dividend is rupees 2. So what is the formula? Cost of equity share is equal to dividend divided by net proceeds plus growth. So dividend divided by net proceeds plus growth, dividend is 2 rupees, 20 rupees is the net proceeds, and 0.07 is the growth rate. So divide the value, add the value with 0.07, you will get the value 0.17. Convert the percentage, 17% is your answer. Next, moving forward, let's calculate the preference share. So what is given information? 6% preference shares of rupees 10 lakh. So it is irredeemable preference share. So what will be the formula? Preferential dividend divided by net proceeds. Very easy. So preferential dividend divided by net proceeds. So what is the preferential dividend given? 6% of rupees how many? 6% of rupees 10 lakh. So 6% 10 lakh into 6%, it will be how much? It will be 60,000. So what is this? Your preferential dividend. Preferential dividend will be 60,000. What is the net proceeds? 10 lakh is the net proceeds. If you substitute the value, you will get the answer as 6%. Next, let us calculate the next source of finance, that is your debenture. So what is the debenture value given? The debenture value is given as 8% debenture of rupees 100 each, 30 lakhs. So what is the debenture? 8% is the interest for rupees 100 each. So the interest will be 8 rupees, net proceeds will be 100. So it is also the irredeemable problem. So let us solve the problem. So tax rate is given. Yes, tax rate is how much? 0.50 because it is 50%. So irredeemable after tax formula. So what is irredeemable after tax formula? Interest 1 minus tax divided by net proceeds. So anything 1 minus tax, interest divided by net proceeds. Both the way it is similar. The answer will be similar. Debenture, cost of debenture, interest 1 minus tax. So interest, as I have told you, my dear students, it also can be taken up on 100 rupees face value. 100 into 8%. If you do it also, the answer will be similar. If you take up the whole amount, that is your 30 lakh amount also, the answer will be similar. So 30 lakh into 8%, it will be 2,40,000. So 2,40,000 will be what? Your interest. Interest will be 2,40,000. So 2,40,000 is the interest. 1 minus tax rate 0.50. The value will be 0.50. 1 minus 0.50, it will be 0.50 divided by net proceeds is 30 lakhs. So if you do it, 0.04% only you get. If you have confusion, you can also try in this. The face value is given. So what is the face value? 100 rupees is the face value. 100 rupees into 8% interest, 8 rupees will be the interest. So either ways also the problem can be solved. So anything which is easy for you, you can follow that. Whenever the face value rupees 100 is given, you can take up the value, or whenever the face value, that is rupees 100, 110 is not given, so you can take up directly the book value, the amount of 30 lakh, 20 lakh, the answer you will get similar. So 100, interest will be how much? Interest will be 8 rupees, net proceeds is 100. So if you substitute the value 8 rupees, 1 minus tax rate, so 1 minus 0.50, it will be 0.50 divided by net proceeds 100. If you do this also, the answer will be similar. That is your 0.04 only, you will get it as an answer. Anything can be tried. So let us compute WACC. Sources of fund: equity capital, preference capital, 8% debenture. Book value given in the question: 40 lakhs, 10 lakh and your 30 lakh. So how much? 40 lakh, 10 lakh and 30 lakh. So it is how much? 80 lakh will be your total value. So 40 lakh divided by 80 lakh, 0.5. 10 lakh divided by 80 lakh, 0.125. 30 lakh divided by 80 lakh, it will be 0.375. If you multiply weight with specific cost, you will get your weighted average cost, and if you calculate for all the sources of finance, the total overall cost will be 10.75%. Now we have to calculate the new capital, since because the external finance we have taken, again we have raised the fund of debenture of how many rupees? Of 20 lakh of rupees. What will be the interest? The interest will be 20 lakh. 10% debenture is the additional fund we have raised. For this, the company has decided from 2 rupees to 3 rupees increase in the issue of dividend, and the net proceeds of that is rupees 15 per share. So let's calculate the new specific cost. So cost of debt is equal to interest 1 minus tax. Cost of debt is equal to interest 1 minus tax divided by net proceeds. Okay, so what is the interest percentage? Interest percent is how much? 10% on 20 lakh. So the interest will be 2 lakh divided by net proceeds will be how much? 20 lakh. 1 minus 0.50, it will be 0.50. If you substitute the value, you get this 5%. So this is the interest calculation. 20 lakh into 10%, it is 2 lakh. Now let us calculate the calculation of new cost, that is new equity capital cost. So dividend divided by net proceeds plus growth. Dividend is 3 rupees and the net proceeds is 15 rupees. There the net proceeds was 20 rupees. Now it has been decreased to 15 rupees. So the value you get is 27%. Now let's calculate the computation of new weighted average cost of capital, because we have raised the external fund of rupees 20 lakh debenture of rupees of interest of 10%. Now let us calculate the computation of new WACC. So what is the computation of new WACC? What is addition in the problem? Addition is 20 lakh since the company has raised again 10%. 20 lakh debenture. So we are calculating new WACC table for that. What is the format? Sources of finance, book value, weight, specific cost and weighted average cost. So equity capital. So what we have got, the book value 40 lakh, preference share 10 lakh in the question and 8% debenture 30 lakh in the question. What we have got? We have calculated that. So 30 lakh, how much it is? 10 lakh and 40 lakh is the weight that we have calculated. Additional how much? Additional is 20 lakh. So additional is how much? Additional is 20 lakh. So that additional 20 lakh, if you add it, you'll get how much? 1 crore. So 1 crore is the total value. So if you divide the individual book value with the total value, you get the weight. So after that, whatever the specific cost you have got, so that is your equity, cost of capital, cost of preference shares, cost of debentures, specific cost we have calculated in the previous slide, that you have to take, multiply with the number weight, you'll get the weighted average cost, and the total of this is overall cost of capital, that is your WACC. So when company uses additional debt or additional equity, additional preference, any of the cases, they have to compute the WACC table as well as new WACC table. Moving forward, the last problem for today's class. My dear students, solve all these 4 problems very seriously. So this is all your 15 marks problem. So based on this problems, you can take up the other problems as a reference and then solve the problems. They are very interesting and very easy scoring in your examination. So a transport company is interested in measuring the overall cost of capital. You are being supplied the following balance sheet. So in the balance sheet only you should take up what? Your sources of finance. No other information has to be taken. Only take up what? Sources of finance. Debenture, preference, equity and retained earnings has to be taken. So these 3 finance book value we will take up 9 lakh, 45 lakh, 12 lakh and 4 lakh 55,000. So current liabilities ignore, fixed assets and current assets we are ignoring. Next, anticipated external financing information. So what is the information? 20 years, 8% debenture of rupees 2,500 face value, redeemable at 5% premium, sold at par, 2% flotation cost. It is what? It is your redeemable debenture problem. Next, 10% preference shares of rupees 100 each. Sale price is 100 per share, 2% flotation cost. Again, it is what? Again, it is your redeemable preferential shares. So, equity share, selling price is 115 per share. Flotation cost is there, 5% per share. Corporate tax is given. How much? 55%. And expected dividend is rupees 5% per year. So, it will be how much? 11 per share. So this is what? This is your growth rate. So what is this? Dividend growth is how much? 5% per year. So this is the value given. So let us compute the value. Moving forward, now let us calculate the cost of debenture. So what is this formula? So it is redeemable formula. So redeemable formula. So interest, what is the interest that we have calculated? 2,500 into 8%, it is 200. So interest we have calculated 1 minus tax. So tax rate we have taken. So tax rate is how much? Tax rate is how much? 55%. So 55%, if we convert into decimal, it will be how much? 0.55 is the tax rate. So 55% is the tax rate. 1 minus 55% that we take up the tax, it will be 0.45 plus, so 55% is the tax rate. So let's substitute the tax and maturity value. So maturity price, that is 2,500. We are redeeming at 5% premium, 125. So total will be 2,625 will be the maturity price. And next, what is the net proceeds? Net proceeds, we are issuing price is how much? 2,500 is the issuing price, and 2% is the flotation cost, that is your 50 rupees. If you deduct that from the net proceeds, and the net proceeds you get is how much? 2,450. So net proceeds divided by number of years is 20. Again, 2,625, that is your maturity price, plus your net proceeds, again divided by 2. The value you get is how much? 3.89%. So let's substitute all the values to the calculator. You'll get the answer. So how do you calculate it? So first you have to solve this bracket. Second, the denominator bracket, keep the values. Next, you solve 1 minus tax. So whatever it is there, you add it with the number and multiply with the interest divided with the value. You get the answer 3.89%. So this is step 1, step 2, step 3, step 4 and step 5. And again, if you divide the value, whatever you get, that is your step 6, and the value you get is how much? 3.89%. Moving forward, so we have got the information regarding preferential shares. So 10% preferential share of rupees 100 each. The dividend will be 10 rupees. Sales price is 100, net proceeds is 100, 100 into 2%, 2 rupees will be a flotation cost, 100 minus 2, 98. So preferential dividend divided by net proceeds, because it is a redeemable preference shares. Number of years is not given. And let's calculate the cost of equity. Question, debenture is given. So what is the value given? Dividend is given, 11 per share is the dividend. Next, 5% growth rate, and your 115 is the selling price. So no issuing cost. So let us substitute the value. Dividend divided by net proceeds or market price plus growth. Growth is 5%, 0.05, 11 rupees is the dividend, and the net proceeds is 115. So your remaining value will be the flotation cost. So how much will be the flotation cost? 2% will be the flotation cost. If you take up that flotation cost from this, you'll be receiving what? 5.5 is your flotation cost. For 5.5 is the issuing cost. Lessen that issuing cost, 115 minus 5. So 5 rupees is your flotation cost. So 5 rupees, deduct that 5 rupees from your flotation cost, that is expenses while issuing the shares, then you will get is 110. 110 will be your what? Net proceeds. 0.15 you will get the answer. If you convert that, you will get 15%. So your flotation cost is rupees 5 per share. So now let's calculate the computation of WACC. Sources of finance, equity share, 8% debenture, 10% preference share. So as I have told you, my dear students, retained earnings is always equal to your equity capital. So cost of equity is equal to cost of retained earnings. So that is what we have learned. So the cost remains same. So 15%, 15%. So 15% is your equity cost. The cost will be similar to your retained earnings. So retained earnings, cost of capital is similar. So all this information we have taken up from the balance sheet. 9 lakh, 4 lakh 50, 12 lakh. So all this information we have taken from the balance sheet. The book value, the weight. So the total of it will be 30 lakh. So 12 lakh divided by 30 lakh, 0.4. 9 lakh divided by 30 lakh, 0.3. 4 lakh 50 divided by 30 lakh 0.5. 4 lakh 50 divided by 30 lakh 0.15 is the answer. And if you compute the specific, whatever the specific cost we have calculated, that specific cost we will be taking up. So 15% will be our cost of equity. Retained earnings also will be same. So 15%. So this 8% debenture value, that is your 3.89%. We have taken debenture value. 10.20, that is your preferential. That is your preferential specific cost we have calculated, cost of preferential shares. So then if you multiply weight into specific cost, you will get your weighted average cost. If you total that entire specific cost, the value you get, the overall capital, the overall cost of capital will be 10.94%. So this is what the answer is all about. So I'll just move out of the screen, my dear students. Kindly take up the screenshot. Problem number 1. Working sheet. Cost of equity, cost of debt, computation of WACC. This is your computation of WACC. Computation of new WACC. Problem 2. Problem number 3. Problem number 4. That's it, my dear students. Thank you so much for joining for today's class. Hope the session was very interesting and fruitful. So stay tuned for the next class. Smile is the biggest jewel you can wear. Keep smiling. Thank you.